I want to tell you an introduction to investments. And for that, I want to review the notion of making money. I need you to understand that in finance, the word make money has two interpretations. And these are going to be very important for what we're going to be talking about here. One interpretation is the result of investment activity. You invest to grow your money, right? That's what investors do. And that's what investing equals making money. And this is the notion that most people have about investing. You invest and you make money. Anybody's an investor here? You're not an investor? I'll show to you that you are all investors. Okay, you don't know it, but you are all investors. Anybody invests actively? You buy and sell something. You buy stocks, Bitcoins, yeah? So you're an investor, right? So that's one interpretation of the concept of making money. But the one which is going to be more important for us is what the investment sector is, which is much, much bigger than that, which is you invest to make fees. And that's going to be more important for you because very few of you invest, right? You just told me. But many of you, in fact, all of you, if you end up in the investment sector, you'll be part of that. And for that, investing is the act of making fees. Can you make money by losing money? Well, yes, if you get paid to lose money, right? Understand? So that's where the concept of making money, losing money, it needs to be explained properly. And that's what I want to do. I want you to understand the difference very, very well. And I'm going to do that my favorite way, with an example. What I'm going to do in the first hour, I'm going to build an investment here in front of your eyes. In fact, if you want, we can do it together. It's up to you. Depends how participating you want to be in class today. We're going to create an investment. And as we create an investment, I want to explain to you the investment fund life cycle, which starts with the conception. And that starts with a question. Why? What are we doing? So we will go through that. And then we will see that it's actually born. At some point, the investment will be born. And that process is different. Birth is different from conception. The conception is first, always first. Then it's going to grow. And then it's going to die. And we're going to see all of that today in the first hour or so. From conception to birth to growth to death. And I think only then you will understand, well, then you will understand very, very well the difference between making money, losing money, and all the nuances which are related to all of that. And I'm going to start with an example. This is my favorite example. And I have to tell you, I've been doing this for exactly 20 years now. Something happened. It was a very good story. It happened in the city of Montreal. And you are Torontonians. You would relate to this also. The city of Montreal has a very interesting challenge. Toronto does too, but Montreal is worse, which is how do you clean up snow? The city of Montreal spends over $100 million a year cleaning up snow. Toronto is also about $100 million, okay, cleaning up snow. So when you get out of your home in the winter, the streets are clean, and there's a cost to that. And let me explain to you how that is done, because that's done through a public tender. The city does not actually clean the streets. They clean some of the streets, but most of it is not done by the city. It's done by a company that has a contract with the city. And I'm not going to get into the full details of how that's done, but what the city has to do is you have to select which months you want the company to clean the snows. And the charge is more or less like a flat rate. Think it's a flat rate, right? So you say, I want to have the snow, the streets cleaned in November, so you pay $20 million, and then the streets will be clean in November. Would you buy that service in November? For Toronto, for example? No, that's $20 million away, right? Will you buy that for April? So Toronto does not buy this for April. In April, what we do is there is snow, we wait for the sun, and then the sun will melt the snow. It happens. I mean, but actually, the year that in 2003, Toronto had a problem. After 3 days, there was a snowfall in April. After 3 days, the snow was still there, and traffic was impossible, and trucks could not deliver. So they had to call the company and said, clean up the snow. I said, okay. How much? 50% of next year's budget. Okay? For clean up the snow in 1 day. About $50 million. What are you going to do? You have to take it, right? So this is a very good example. In Montreal is worse, as you can imagine. You know that Montreal has a lot more snow than Toronto. So this process is a process which I would like to call it a transfer of risk. You're going to see that, okay? You have a risk. The city has a risk. You can say, no, I don't want, to pay for snow cleanup in November, but then something happens and, oh my God, I mean, why did I say no, right? Okay, so because of that, someone had an idea, I suspect a lawyer, and the idea was this is a true case. The idea was happening in Montreal, okay, not in Toronto, happening in Montreal. And the idea was the following. This is Mont-Tremblant. Have you been there? Yeah? Okay, well, they have the opposite problem, don't they? They're very happy if there's snow in April. They're even happier if there's snow in May or November. On the other hand, they are very unhappy that year, I forgot what year it was, when at Christmas time there was nothing, only mud, not one flake. Right? You can imagine. Anybody skis here? Go ski? Yeah. So this is a big business, right? And these ski resorts, they need to hire people, they need to get everything ready, and there's a lot of fixed costs. So someone had an idea, and the idea was to do a snow swap between them. I'm going to make it up, okay? Because this snow swap did not work. You will see why. But basically, the snow swap works as follows: if there's no snow, we'll get the city to pay some money to the ski resort. I'm gonna pick a number, a simple number, like $1 million or 10 million, something like that. Simple. But if there is snow, then the payment goes the other way. So this is a way for the city to build up a budget if there is snow outside of the normal time. And this is a way for the ski resort to also build up a budget if they have some lack of snow situation every once in a while. This diminishes the risk, you understand that. Whether the number 10 million makes sense or not, it doesn't matter. I'm just picking a number. Because the interesting part here is that when this swap agreement was drafted, in principle they were very happy until one lawyer realized that there was something missing. The snow swap agreement did not say where they were going to measure the snow event. And you would think this has a very simple solution, right? No, the deal died. They could not agree where to measure the snow. It happened. By the way, a footnote, very important footnote. This thing I'm talking about, which I've been talking about for 20 years, now is part of a very important new business which is developing. It's called parametric insurance. These are insurance policies which are not related to damage. They're related to events. Okay, it's a very big deal. And I think it's going to become very, very much bigger, especially as we see natural disasters perhaps happen more frequently. The problem with natural disasters is that if you have a claim based on damage, you need an adjuster to come and check the damage. And when something bad happens, it takes months before they can get to your house, for example, right? Whereas the parametric insurance is immediate. In an hour, you get paid, right? Anyway, that's a different lecture. I want you to understand that all of these things have many different sides to them. So what I want to do is I want to pretend I was there. So everything I told you so far is true. I'm going to now go into the make-believe. I'm going to imagine that I was there. And then what I want to do is say, wait, don't go away. Okay, everybody stay here. Let me propose a different deal. A different deal. The deal is ski resort, you pick wherever you want to measure the snow. I don't care. And city, you pick wherever you're going to measure the snow. I don't care. And I'll do 2 swaps with each of you. I will do this. The swaps will be different because the trigger event is at different locations, right? I take that risk for 10% of the cash flows. That's the deal I propose. You understand what I'm saying? So I charge $1 million to each of them. I was thinking it was a $10 million notional, right? I charge $2 million and then I take care of those cash flows. Is this a good deal? I need $20 million for that. Anybody has $20 million here? No, you don't? Not yet. Not yet. Okay. It's a matter of time. Yes? Okay, but if you had $20 million, would you do this deal? Raise your hand if you would do this deal. It's a 10% return. 10% is pretty good. And if interest rates are 4, it's actually 14% because you still collect your interest on your money, right? You only have to put it in an escrow account just in case. So who would do this trade? Raise your hand. I want to know. 1, 2, 3, 4. Okay. Who would not do this deal? Only you would not. And the rest of you are what? You want to be unemployed, I guess. Unemployment is not good. I don't recommend it, okay? So either do or don't. But don't
Doesn't it depend
be
on how
unemployed.
much snow there is?
What?
Doesn't there depend on how much snow there is?
No. Let's think about this, okay? To think about this, I mean, this is a math course, so enough of this. Let's bring some numbers into this. I'm going to create some cash flows. That's the way we think. It's not a bond, but we think of this as a cash flow. And I'm going to choose a positive correlation between the precipitation and the 2 locations. Obviously, if the ski resort is very far from Montreal, then that would be a very risky proposition. But if it's very close, it would be a less risky proposition, right? So I'm going to pick my favorite correlation number. You know what that is. It's 50%, right? Because I know the numbers. If I pick a correlation of 50% between the 2 events, I know there's a 75% chance I'm just exchanging cash flows by both counterparties. I don't know if it snows or it doesn't snow. I don't care. If it snows, I collect money from the ski resort, give it to the city, and I keep 10%. Right? Otherwise, I'll do the opposite, and I always collect 10%. So 75% chance I collect 10%, and I just exchange cash flows. It's a good deal. I'm happy with that, right? Well, there's a 12.5% chance that I collect money from both. Because there's no snow in the city and there's snow in the ski resort, and then I collect money from both. And I know the probability is 12.5%. That's related to the 50% correlation. We saw that number, 2 weeks ago? That calculation, the correlated coins, remember? So again, here it is. You're following me. This is very simple probability. I told you, this is so easy that even you didn't understand because it was too easy, right? But now you're past that. You understand easy probability too, yes? Okay, so there's also a 12.5% chance that you have to pay both, in which case you lose $18 million. You understand that? Okay, so we got the cash flows, except the cash flows are probabilistic. Now we put them together. And for that, I'm going to do the investment parameter analysis. Let's very, very simple. How much I invest? I invest $20 million. My rate of return is 10% in addition to interest rates. So if interest rates are 4, then it's 14. And then the volatility, the standard deviation, is what? I have the cash flow, so I just do the calculation. You see that there? It's 50%. 50%. So I have an expected rate of return of 10% and a volatility of 50. People who invest will look at this and say, oh, not good. There's this quantity called the Sharpe ratio, which is the division between both. We're going to understand the Sharpe ratio very, very well today. We will end with that today. Sharpe ratio of 0.2 is not so good. So this is not a deal worth making. The risk is too high for the return. So what did I tell you? I just wasted 5 minutes of your life? No, of course not. I never do that, right? I never do that. I just realized I need to be smarter. And now I'm going to have a very, very good idea to turn a bad deal into a good deal. Okay? Nothing is easy. But what I want to do is I want to go around all of North America and I want to do the same deal in 100 places. What happens if I do that?
Your volatility is going to decrease because you diversify your
Exactly. My volatility will decrease. By how much?
100 times, square root of 100.
A square root of 100, for sure. Exactly. Why? The cash flows from these deals are independent, are they? How about global warming? Global warming doesn't affect us, not for the cash flows, right? Because the events that we're looking at are the events that give us that geographical spread risk between snow precipitation. If now there's no snow in North America and becomes a tropical garden, then we just collect money from all the cities, we give it to all the ski resorts, we still make 10%, right? It's the differential. The differential that we make money on is the differential whose correlation we care about. And let's say the correlation is 0, yes? Okay, so then if I just pick these locations, I just give you the names. You may recognize some of them. You may have skied in some of them. You may have visited some of them, right? And then what I do is I have a new investment opportunity in front of me. My revised investment parameters are what? $2 billion, because it's 100 swaps times 20 million each, that's 2 billion. My average return is the same, 10%, in addition to interest rates, yes? And drum roll, the standard deviation is now 5%. Gives me a Sharpe ratio of 2, very, very good. This investment is actually very, very attractive. It's better than investing in the stock market. Better than Bitcoin, better than most things you can imagine. What's the problem? Do you have $2 billion? I believe some of you may have 20 million. Why not? Okay, and if not, it's just a matter of time. But 2 billion is a bit too much. Maybe not everybody has $2 billion. So what do we do with this good idea? I had a good idea, $2 billion. What do?
We go to the bank.
We go to the bank. Okay, let's do that. Let's go to the bank. Okay, who wants to be the bank? You want to be the you're gonna go to the bank and you're gonna be the bank. Then the answer is gonna be yes for sure, right? Yeah, no, let's make it a bit more realistic. So you go to the bank. Who wants to be the bank? You want to be the bank? What do you tell the bank?
I'll give you 15%.
15%.
Yeah, I charge high rates.
Okay. So you need. What do? You just went to the bank.
Can I get like 5% from you? That's not
Doesn't work.
worth it for me.
Doesn't work. It's not gonna work. So don't go to the bank. It's not gonna work. Banks don't do this. Banks think of a bank as someone who just likes to charge ATM fees. Okay. I don't know what you know about banks, but no. You want to open a bank account? Sure. Here, open a bank account. We'll charge you $10 a month. That's what the bank will say. I'm exaggerating just a little bit. You understand? So that's not gonna work. What do? You
get investors?
Okay, you get investors, exactly. So do you know any investors? You are an investor yourself. Yeah. You don't have 2 billion.
2 billion in the
Okay, so you go to investors, and what do you tell the investors? I'm going to exaggerate just a little bit today so that you understand what I'm saying, right? What do you tell investors? So,
I have a great idea. Please give me money.
okay, the minute you do that, you just broke the law. To say what you just said, you need to be registered with the Securities Commission. Are you registered? No, okay. So then you just broke the law, and you can be in very serious trouble. You cannot do that. Asking for money is a highly, highly regulated business. Highly, highly regulated. Remember what my first slide today, I told you there were two differences of making money, which is grow your money or collect fees, right? Well, the collecting fees is the part. Even if you don't collect fees, even if you give advice for free, you still need to be registered. It's a very highly regulated business. Yes. There you go. Oh, I thought you had a question. Yes.
Does this extend to angel investors as well?
Everything. Everything. So, but we'll get into that. But then, damn, we have a good idea, right? We have a good idea, and now what do? It looks like you have a,
Sorry, I
something to
just
say?
moved my hands.
yeah? You just move your hands. Okay, all right. You understand the conundrum we're in? Yes.
So obviously you have to write a prospectus, is that?
Okay, so now, exactly. So now, we have to do more than that, right? We have to, before you write the prospectus, you need to have a registered company. And actually, a prospectus is for a fund. So what I want you to understand, before we get started, is that there's a process for these things to happen. You can't just make investments like that. Investments are very heavily regulated almost everywhere. Almost everywhere. Okay? So let me walk you through that process, because this is very important. And what just happened is everything I've talked about so far today was what I call the conception, the idea. Not the fund, the investment is about to be born. Right now, everything we dealt with were ideas, right? But these ideas, we cannot make them real, because to make them real, we need real money. And to make things with real money, we need to create a certain amount of infrastructure, which I want you to understand. I don't want you to understand only the quantitative analysis without knowing that there's a whole structure out there which you needed, which you need to make these things happen. Okay? And you will see why. You will see why. So just I told you we're gonna do this. We're gonna create an investment today, a real one. Okay? Real one. So a fund is born. Now, what is a fund? Think of a fund like a company. It's a legal structure. Okay? It could be a company. Actually, it could be a company. A fund could be a company. It could be a trust. It could be. I'm not gonna give you a course on law right now. Although I'm gonna be using a lot of terms from law, but this is gonna be a structure, legal structure, that has investors in it. That's where it could be a limited liability company. It could be. Sometimes a fund is a limited liability company. And if you do that, then you don't need to be registered. But then now you're not selling, right? You're creating a company and investors put money. It's different. It's different. Now, this fund has investors, which are the ones that put the money. And then the fund has a management company. Now, this is something very important. This is the most important thing that I need you to understand today, which is the concept of the management company and the fund. What's the difference between the fund and the management company? What's the difference?
Would the fund be like ran more by a board of directors, and the management companies more like actual employees, like
Exactly.
potentially academics?
Yeah.
Like
So let's say that you apply for a job. Where do you apply for the job? To the fund or to the management company?
Management.
Management company. You don't apply for a job at the fund. As we're going to see, funds, I exaggerate, funds have no employees. So you, if you are employed, will be working for a management company. That's why you care about the management company more than you care for the fund, because the fund is not going to pay your salary. The management company will. Have you heard as people say they work for a hedge fund? Have you heard that? Is it true? They work for a hedge fund? No. No one works for a hedge fund. They work for a management company that manages a hedge fund. Understand? Yes? Very important. You will see this difference is very, very important. Now, the fund has other service providers. They have a bank, because they need to put the money somewhere. They may have a broker because they need to buy and sell stuff, as we will see. Okay, do we need a broker for the $2 billion snow fund I'm building? Do I need a broker? No. I don't need a broker because these snow swaps are not tradable. I will need a very good legal team, but not a broker, right? But normally funds need a broker. They also need an administrator. Do you know what the administrator is? It's essentially the company that counts the money and reports that to the investors. The investors, how do they know how much money their shares are worth? How do they know? All those of you who invest, how do you know how much money your investments are worth? How do you know?
Volume times current price.
No. I want you to understand this also now, okay? So, again, I don't know how you invest, but most people, I imagine many of you, would just go through a company like a Wealth Simple or something like that, yes? Or maybe Interactive Brokers or something like that, yes? I'm not doing any publicity for anybody. You will have companies like that. Well, there's something there that it looks the same to you, that the company you're investing with seems that they do everything for you. They have your money, this and that. They're actually performing all of these functions at the same time. And there's a piece of that business, which you call the administrator. These are accountants whose job is just to count the money. And they tell you, you have these shares of this, these shares of that. They do the multiplication and they report that number to you. Okay, but as you will see today, this job is very, very difficult. You may have very simple investments, and for simple investments, it's just a simple multiplication, as you said. But for many investments, that's not the case. And this example I have here, you will see is a very complicated investment, right? In fact, who wants to be, let me have 4 investors. Who wants to be my 4 investors? Can I have 4 investors? Wow, you want to do everything. That's great. This guy's going to do well. He's going to have jobs, everything. So I have 5 investors here. I need to, so 1 investor, 2 investors, 3 investors, 4 investors. I'll save you for the next one, okay? So I'll have 4 investors there, right? At 500 million each, yes? Right? Okay, so you guys invest. I'm going to be the CEO of the management company. I've reserved that job for me, okay? Understand? Yes? I'll be the CEO of the management company. So who wants to be my bank? You're the bank, okay. Forgot your name. Harsh, that's right. Harsh is my bank. The Harsh Bank. Yes? Good. So you're the bank. So I don't need a broker, but I do need lawyers. Let's say who wants to be my lawyer? You're my lawyer. Your name?
Mike, sorry.
Mike. Okay, so Mike and Co. At law. Yes? Okay, right. Okay, good. And lawyers. So have 4 investors, have the fund, have the management company, and let's say that I'm registered, so I'll have to do that with you. I'm registered so I can go around and I can ask people for money. I cannot ask you for money until I'm registered. But if I'm registered, 500 million, it all goes into the bank, so now you have $2 billion. Yes? Okay. And you wrote everything. Good. There's one more role that we have to do here, which is, who wants to be my administrator? Do anybody wants to be my administrator? You're my administrator. Good. You like to count money. All right. What's your name?
Michelle.
Michelle is my administrator. Okay, great. You're very good at counting money, yes? You never make mistakes.
Yes.
Never make mistakes? Okay. Okay, but and you know what? Maybe you do. So I need an auditor. An auditor is going to check Michelle. Who wants to be my auditor? You are my auditor. Okay, what's your name? Erhan. Erhan is the auditor of Michelle. So at the end of the year, okay, you're going to inform all of the investors about how much money their investments are worth, right? And you're gonna get information from where? What do you need to calculate the value of these investments? You have a very difficult job. You're about to realize. What information do you need? So picture this, right? They have invested $2 billion, and let's say we start in August, okay, there's no snow, everything is, oh, by the way, when I teach this course in some places, I need to tell them that there's no snow in August in Montreal, okay? I don't need to tell you that, yes, okay. So in August, there's nothing going on, right? Okay, great. So they put their money, and now they expect that you report to them the value of their investments, say, at the end of every month, right? Okay, so how do you do that? You need to send them a letter, an email, okay? We said, well, this is the financial statements of the company, and your investment is worth whatever, okay? So what would you tell them that their investment is worth at the end of September?
The information I need, or like,
No. What email do you tell them? What information will you give them at the end of September that their investments are worth? 500 million, 500 million, 500 million, 500 million. That's the money they invested, right?
I assume it will work the same because like there's no snow.
So you have to speak more slowly and very clear because I'm very far from you.
There's no snow, and the business is like related to snow situation. Therefore, their investment will be working the same.
Exactly. So how much is 500 million? 500 million? Yes. You think so? Yes. And then in October?
Assuming there's still no snow, then it will still.
Okay. So let's say big snowfall in January. What do you tell them in January?
Then the profit will increase, or there's like changing in there.
You think so? You think so? Thank you for the answer. Okay, that's the answer I was hoping to get. No.
Just out of curiosity, like, is the ski resort open, like during like those months or not?
What?
Are the ski resorts open during that time of the year, or?
Yes, let's say they are open. Yes,
Oh,
but in this course, we've learned how to price securities. Remember the 33-cent game? Yes. How did we price securities? Methodology. Did I ever teach you how to price a snow swap? No. So we would have to go and see how we price snow swaps, right? Right? How? So now I need a new chapter, just for you, not for the rest. They don't care. Just for you to learn how to price snow swaps, right? But think about it for a minute. How can we price snow swaps? Think that you can't. It's very hard. So very likely, Mike, lawyer, here, when we wrote the prospectus, the word is actually, I'm going to call it offering memorandum, okay? I'm coming to that. All of this is going to be in slides that I come. There's a very important chapter that says how we're going to price all those securities. And very likely, we're going to say that the snow swaps will be priced at zero. Because this is what will happen. Imagine you price them in any other way. Remember that time I spoke about value at risk being part of the law, remember? And I told you how challenging that would be to even define the concept of average, remember? If I want to have a definition that stands a legal challenge for a snow swap, very likely the answer is no. So I'm just going to say they're always priced at zero. And when you get cash, yeah, cash you price. You're good at counting cash. But you're not good, no one is good at counting the value of a snow swap. So very likely we'll say no. We'll say the price will be zero. Very difficult job, because you have to price sometimes securities which are very difficult. And not even courses such as this one prepare you for that, right? So, but you understand that some of you may actually be working at administrator houses, and you may not be so lucky as to just say, no, I price it at zero. And no, you may, because if investors want to redeem their investments, right? Let's say that, who wants to be a fifth investor suddenly? Fifth investor? Fifth investor. You guys, you have to, you don't want to be unemployed, okay? So let's say you want to sell your investments to him, right? You need to know how much money he should pay for the investments. And who's going to determine that? Michelle is. Right? So this is how that, and that's why your role is very important. You determine whether this guy is not only make and lose money, but also how these things, these shares can be traded. So, understand? Right. So that's the fund. But the management company, what about the management company? Why did I do this? Do I do this because I like these guys so much that I want to work for them? I want to work for them for free? No. I told you, we stopped working for free in reading week. So we should discuss how much we get paid, no? Understand that? All right. Now, before I do that, this is a very important discussion. It's going to take us some time. I want you to understand that. Before I do that, I say now that all of these investments here, all of these service providers need to be conflict-free, right? What would happen if you and I have a relationship, okay? All right? Yeah? And then you get all of this, and then this actually happens, as I'll tell you, right? As an investment manager, do I prefer that you give a certain value to these shares or not? Imagine you could lie, but you could do something illegal, right? Imagine, I said imagine, okay? Yeah? What's better for me, for the management company, is that you lie on the upside, right? Right. Or imagine you have a relationship with him and he's going to sell his shares to him. It would be, yes? Or you have a relationship with him, in which case you want to lie on the other side. But now you have an auditor, right? So that's where you're going to check all those numbers, right? Because we don't trust her. Suddenly we don't trust her.
I don't trust anybody.
You don't trust anybody. You're an auditor, right? But what if you have a relationship with her? You understand? Yes? This gets very interesting. And this may look that this has nothing to do with math, and I don't know if it does. But this is very important. All of these things, they need to work for this thing. So this is a whole new chapter. Actually, there are courses in legal departments where this thing just needs to be understood very... I teach this, by the way. I love teaching this. This is great. Okay? But...
Okay, my question is, okay, what about the bigger management companies, like JP Morgan?
Yes,
which,
yes.
I don't know, technically it's a bank too.
Yes.
It's also a broker,
Yes.
administrator, management.
Absolutely, yes, exactly. And now I mean, this is going to be on YouTube, as you know. I'm not going to mention names, but how can you cheat? Let's talk about that for 5 minutes, right? What if you are a very big corporation? Are you going to cheat here?
I think those big banks, they have like the Chinese model, like where the broker side cannot talk to the investment side.
And you trust that? But how about this? And actually, there are safeguards in place, and that's why this is a very heavily regulated business. That's why it's so heavily regulated, right? That's why you have to. Not only you need to be registered, but there is checks and balances checked upon you, and there is investigators, and there's spot checks. As you know, I run an investment company, and so the regulators come and say, okay, everybody stop. Let me go through all the records, and then they check that everything. They don't trust it. They don't even trust you and you, right? So that's where these things happen. But let me, for example, I'm not going to get too deep into this, and certainly I'm not promoting any type of illegal or unethical activity. But imagine this. Very simple situation, right? You have a broker. We don't need it for the snow shop, but if you're buying and selling stocks, you use a broker, right? Okay, well, if you are a very big organization, very likely the broker is yourself, Chinese walls and all, but yes, yourself, right? Well, what's the brokerage fee? Yeah.
I assume it's like a commission of some sort.
Yes, exactly, but how much? High or low?
Low.
Low? Why would it be low?
Yeah.
Who's paying for the brokerage fee? They are. But who's the bank? Well, you're the bank. I need a broker. Who wants to be the broker? I need a broker. You're the broker. Oh, okay, yeah, very smart. Yes. So you're the broker, right? So what fees do you charge?
The investment amount, like a percentage, like.
No, you and I negotiate the fees, right?
Oh, yeah.
Right? So, but if you and I work for the same corporation, what incentive do you have to give me a very good deal? Do I pay for it? I'm the management company. I'm the one who hires you. I'm the one who collects the investments. Who pays for your brokerage fees? No, they do. I don't have any money. I'm poor. They pay for the brokerage fees, right?
You should get a percentage for distributing the funds.
Sorry?
You should get a percentage for collecting. and
Me?
investing.
I'll tell you how I get paid. Okay, I'm coming to that. But you get paid, and we negotiate, right? Yes. And what if you and I have a relationship now? Have you heard of the word kickback? Yes? No, you have not. Okay, good. Good. Stay away from these things, by the way, okay? These things are I'm recommending you just don't get involved in this. But see, this thing of the conflict free is very important, because if you don't have that, these poor investors can really be financing a lot of things that they shouldn't, right? You understand? Yes.
Isn't kickback illegal?
Sorry?
Isn't you saying-
It depends. There's a lot of regulation which is coming up all the time, and sometimes it's not illegal. No. Yeah. Sometimes it's not illegal. So you have to be very, very careful. When I teach courses on investments, here I'm only doing 2 lectures, but when I teach courses on investments, there's one thing I teach. The most important thing is to be very, very smart. Okay? Because everybody's going to try to steal your money. So just make sure that no one can. Okay? I'm coming to that. I'm coming to that. You understand what we're dealing with here? Yes? Very complicated situation. So in the fund, let me just complete by saying that, as you can see, there's owners and service providers in the fund, right? And it's very important to understand who you are in that relationship. Now, let me tell you, this structure can get really complicated, and just so I think 50% of you will end up working in the financial sector doing these kinds of things. So I want to be very generous in telling you lots of things that might be relevant. So, for example, imagine that all your 4 investors here, I'm making this up. You're a resident of Hong Kong, you're a resident of Australia, you're a resident of Germany, and you're a resident of the US, right? Imagine I'm trying to have a fund that satisfies all those 4 residencies. It's a nightmare. Especially no one wants to be with the American investor. There's a reason for that. FATCA is a regulation that came up about 10 years ago that makes it extremely. Basically, it could happen that everybody who invested in the same fund as you are can be now subject to U.S. taxes. Just for that. Have fun, right? Say, well, I'm a resident of Hong Kong. Say, sorry, sir, you have to pay taxes to the IRS, right? So because of that, very often what you do is you end up having lots of different funds. So, for example, in my snow fund, I could have, I have an example here of 2 feeder funds. So I could have my U.S. fund for the U.S. resident and my Luxembourg fund for everybody else, for example, right? So the U.S. fund, I open a fund in Delaware, you go there, and then you're there. So they have $500 million, and then 1.5 billion, and they go into different funds. And then I use all of that money to do my $2 billion worth of snow swaps. But they go through intermediary funds, you understand that? This can get very fun. And this is what lawyers do. Without this, no one will invest in your fund. Yes?
Are the intermediary funds generated by the master fund, or are those separate institutions that are someone's entire business fund?
They're all done by the management company.
Okay.
The funds don't do anything. So my company is the one who creates all of these investments infrastructure, because I need to make sure that I service every investor according to their tax jurisdiction, right?
And are those their own kind of group of, like board of directors?
Yes, each of them has their own governance structure with their board of directors, their lawyers, and this and that. The most common location for a master fund is Cayman Islands. Cayman has the advantage that they have an advantage that they have tax treaties with just about every country, so it's okay to invest there. And they have no tax withholding. Just one thing which is very risky for a lot of these funds is forget about I said earlier that everybody who invests in the US fund will be taxed by but even if I do this in Luxembourg, then all of my 3 investors in Luxembourg, they may get what's called a tax withholding. Luxembourg has a tax and say, well, the fund made money and then you're going to be withheld that tax. But I'm a resident of Hong Kong. Or Australia? Why am I getting my tax withheld? Well, that's how the law works. You can apply to get it back, and you will get refunded the tax maybe a year later. But then you have to go through the pain and suffering of getting that money back, hire your team of accountants, and pay a fortune for that, right? So because there's many issues that when you are doing these investment funds, in practice, you have what's called the master feeder structure and this and that. And some of you may be related to that when you do that. Each of them will have their own auditors and their own administrators. So we're going to need now not 1 Michelle, but 3 Michelles, right? 1 per fund, including the master. Okay? But I'm going to go away from that, and I'm going to come to the part that really, really matters to me, which is how much I get paid, right? I told you everybody stops working for free on Reading Week, including me. Today I get paid. Today is my chance. Today I'm going to get paid. And I'm going to have, I just made this up, I'm going to have a fee structure, which is I'm going to be paid 1% of the assets and 20% of the net gains for this fund. So, of course, I assume my investors are okay with that, right? And here comes the real juice. So this is the important part that I want you, this is perhaps the most important thing I need you to understand today, which is how money is made, right? So for that, I'm going to do a very simple accounting. Very simple accounting. So I'm going to have here, who wants to be my CFO? I need my chief financial officer. Who wants to be my chief financial officer? Because this is what this person does. Okay, tell me your name. Sebastian. Okay, great. So Sebastian is my chief financial officer. So you're the one who's doing this, all right? This is your job. And of course, you do this very closely with Michelle because she's the one doing the accounting for the fund, right? You check that she doesn't make mistakes because we don't want anybody to make mistakes. You work for me, the management company. The management company will make sure that everybody works well, no mistakes, right? So she checks, she tells you that there's $2 billion in the fund, right? And you say, yes, $2 billion in the fund. 500, 500, check, 2 billion, right? And you agree, right? At the end of the year, right? Again, I don't know how we're going to value those snow swaps, but at the end of the year, there's 10% made because of money from cities and ski resorts, and then there's $200 million wired into the fund as a result of the swaps. So you check the swaps, you say, you need to get paid, and then you tell him, and then you go and say, oh, I need to send invoices to all these ski resorts and cities, right? Yes, and the wires of that money, those $10 million, go where?
To the fund.
To the fund, exactly. So to the bank here, Harsh will accept them, right? And then at the end of the year, then Harsh produces bank statements that go to Michelle. So Michelle says, oh, this fund, they made money exactly $200 million and 0 cents, right? Yes, that's your number, right? You check it, right? At the end of the year, you'll check it too. Say, oh, I need that invoice. Well, are you sure this is correct? Yes, yeah, okay. 200 million, right? Great. But now This is interesting. Because you are going to issue an invoice to the fund. For how much?
For 20 million.
$20 million, right? So that invoice goes to Michelle. Michelle says, invoice, contract, management fee, yes. So then she tells Harsh to send you us $20 million from the fund, right? Yeah, see that? This starts to get fun. Because then on top of that, you say, okay, I got my 20 now, but how much money did the investors make? They made not 200, 180, right? So now you issue another invoice. For?
For performance fee.
Yes, for $36 million, right? And you receive it, you check it, yes, it's correct, $36 million, right? The auditor will say, yeah, correct. So you tell Harsh to send you another $36 million, right? You understand? Yes? Okay. Now, so the total, the investors make now not 200 million, make 144. In fact, the investors actually are not making 10%, they're making 7.2. Who wants to be my director of marketing for the fund? Okay, great. I have one there. I have two volunteers. In blue, you're my director of marketing, right? I should have made very clear that when you advertise to our investors what's called the pro forma, what we think this fund is going to make, we don't say 10, right? 7.2, right? Otherwise, we'll be misrepresented, and then I can be in trouble. He will never allow me to say 10. He's my lawyer. He said, no, 7.2 with a disclaimer this big, right? Understand? But you see, the investors are making 7.2, not 10. Yeah, and you're gonna do fantastic, big bold letters, wonderful things, but 7.2, right? We don't advertise that. Understand this? How this goes? Great. But now let me ask you a question. Those of you who are not investors and they don't work for me, okay, everybody else who didn't want to raise their hands, now you have to raise your hands. I need to ask you to take a position. Do you want to be an investor or a manager? Which column do you like more? You guys don't vote, okay? You're working. You're with the investors, you're with the, lawyers. Those of you who are not working, raise your hand if you prefer to be an investor. Only one. 1.5. Okay. Raise your hand if you want to be a manager. Okay. Most people find the manager to be a more attractive proposition, right? Why? Why?
I invested $0.
You invested $0. So this is, and then I said, this is true, but then, that's the value of an idea, right? That's what, I created this based on my ideas, right? So if you like to be managers, then you need to think like that, right? This is the entrepreneurial spirit. Most people, they want to be investors. Why? Some people.
It's like passive income in a sense.
It's just passive income. You're just doing your thing, and then you're going dancing and golfing and this and that, and then someone else is working for you and making your money, right? So I can see that perspective too. But it's always true. In the financial sector, you have to know which one you are. Now, I want you to know that all of you are investors, because I think all of you have a Canada pension plan account. Have you ever? So you have never contributed, never been a TA, nothing, never had a job? Oh, you never had a job? I don't believe that. You really never? Oh, can I take a picture of you? You've never had a job?
I actually worked at Chinese McDonald's right from this.
Of course. I thought everybody here has had a job at some point. No? No? Really? Well, if you've never had a job, then but if you've had a job, there's some money of yours at the Canada Pension Plan. Have you heard of the Canada Pension Plan? What is it, by the way? It's a fund like this one. It's exactly like this. And there is an investment manager of that, which is what? Is Canada Pension Planning Investment Board. Some of you, in fact, I highly recommend you apply for a job there. It's a great organization. And they manage all $600 billion. You don't think so?
They don't want me anyway.
They don't want you. Oh, try again. Maybe you applied to the wrong team. I'll talk to someone. Okay? If they're watching this video, they have to hire this guy. Okay? Okay? See, you're all well, sorry. I mean, I have a pension, so yes, I'm definitely there, right? And if you've ever made a CPP contribution, I'm shocked that you haven't. In fact, I am sure you have. I'm sure you have. If you've made a CPP contribution, then you're all investors. If you're older like me, maybe big investors. If you're younger like you, maybe small investors. But you are investors. And someone is working for you exactly like that. What I'm telling you here is what describes the investment process. And the kinds of jobs I presented here are the kinds of jobs that exist when you go there. Did I ever ask for a mathematician? Today. Why not? Why not? Because they're not needed, or what?
Because you already did it. You did the math.
Well, the thing is that math is everywhere, right? So you have to be aware, and that's the advice I give to people who look for jobs in the investment sector is, I mean, your math knowledge is great, but try to understand where you are. That will make it easier to be hired. Okay, it's very important to understand where you are. And in this course, at the end of next week, I hope by then I would have explained to you everything that happens in this sector, so you understand where your value add could come from, right? You're in marketing. You're my marketer person, right? Yes. So why do I need a mathematician to be in marketing? I've for years been warning mathematicians that they should look at jobs in sales and marketing. It's a great space. It's getting more and more sophisticated, and now you need marketing people who understand the products, which are getting more and more sophisticated, right? Like selling self-driving cars, for example, not just for investments, for everything. And you're going to find yourselves, I think you're going to have opportunities for yourselves to be in sales departments. And if you do that, don't think they're not for you. They are, okay? But you will see more of that. And so let me continue with this example. I think you understand where we're getting into, right? And you very quickly understand that I haven't done a single option pricing or a single nothing. And we created a $2 billion business that produces $56 million per year of revenue. It's pretty good. And the investors are happy. They're making 7.2%. Not bad. Not 10, but 7.2 is pretty good. And we're making $56 million in the management. And everybody's happy, right? Everybody happy? Yes, so far. Okay, so this thing that I'm talking about here, of course, this is not a mutual fund. This is an example of what is called a hedge fund. A hedge fund is an unregulated. When unregulated, no, of course, everything is regulated. They can't just do illegal things, but it is a self-regulated entity, and it's regulated with something called the offering memorandum, which is, you said a prospectus. This is similar terminology. It's a document that basically says how these things work. It talks about, for example, portfolio and investment guidelines. Right? So let me give you an example. Let's say that the investors give me this, and then you're my lawyer, so we go and talk to the City of Montreal and Mont-Tremblant, and they don't want to do the swaps. What do we do now? We got $2 billion. What do we do?
Go somewhere else.
We could do two things. Imagine there are no swaps. You can't do swaps. Okay, they're not interested. And they said, damn, I mean, we have a problem, right? So we have to quickly go and look in the offering memorandum. What does it say that we're going to do? If it says that we can only do swaps, then we have to send the money away, right? Or I'm not suggesting you do this, okay? This is unethical, but it's an example of unethical behavior that you should not do. I said, does it say how many do we have to do? He said, no. It says that we only do no swaps. Does it say how many? He said, no. Okay. So let's just go on vacation. We're gonna collect how much? How much we collect? 10 million, right?
Yeah.
Sorry, 20 million, right? And we don't do swaps. They're not gonna be happy when they get reported by the administrator, right? But we have a year. Maybe, I don't know, yeah? Not a good business, don't do that, okay? But if he doesn't say anything, yeah, okay, then I say, well, who's my portfolio manager? I don't have a portfolio manager. Who makes the decisions of what we invest? I need a portfolio manager. You're my portfolio manager, finally. Okay, great. So I say, no swaps, what can we do? And then I ask you, does it say we can do anything but no swaps? I said, no, it doesn't say anything. What do you want to do? Let's buy Bitcoin, lots of it. If it doesn't say, we can do it, right? But then, now if we have very smart investors, marketing person, what did you tell them?
7.2.
We tell them that we were going to, yeah, so you told them 7.2, right? And you explained 7.2 why, because we're doing no swaps, right? If we now tell them we're going to do Bitcoin,
Revolutionary new technology.
sorry?
It's a revolutionary new technology.
Well, yes, but it all depends. Yes, all true, all good, wonderful, maybe the best investment you can possibly do. But what does the offering memorandum say? If it says that we could do anything we want, you guys as investors, you're not very smart, right? Because if you like the investment strategy that I took, which is really wonderful, right? I mean, what's your name? Minghan? Okay. She's great, and she explains all these things to you. You say, wow, this no swap is such a great idea. But then you check that here we're going to do that, not something else, right? Right? That's if you're smart investors. That's if you took APM466 or MAT1856, right? If you didn't take these courses, I said, oh, sure, I don't care. I just give you $500 million, right? Right? Okay, so if you're smart, you will demand that this thing is there. Otherwise, you're not going to invest. It's too risky. You have $500 million that you give me each, and then you don't know what this guy is going to do. Yeah, you understand? Right? It also talks about the fees. How do we know we're going to charge you 1 and 20? Why don't I charge you 2 and 50? Right? Well, Michelle may not let me. Because Michelle runs a very, very ethical administrator firm, right? And every time you pay something, you check that there's a contract. So where's that OM? And so, oh, it says 1 and 20. You can't say 1 and 20, right? So that's there. But there was one OM that showed that it allowed the fund to pay for the college expenses of the children of the portfolio manager. So your children will get paid by the fund. What's wrong with that? If the investors are okay with that, there's nothing wrong with that, right? Right? So you have to read. Reading skills are very important. Very important when you're in the investment sector, right? Very important. Okay, so he talks about the fees. Make sure that no one... Then he talks about the valuation principles and methodologies, and that's what we talked about earlier, right? If these are the investors, how do I value my snow swaps? Sure, these guys are very smart. They took APM466. So if we do call options, we'll use the Black-Scholes formula, and then we'll have to make sure that it's expressed very well. But snow swaps, how do we do that? We don't know. Maybe we don't. And that will be expressed there, right? Every security we buy, which will be in the portfolio guidelines, will have to have a pricing methodology. That has to be there. Otherwise, I'll use this to steal from you. And if you are a smart investor, you will never allow it, right? And more and more and more liquidity provisions. When can investors buy and sell? Imagine I say I can buy and sell every month, right? Would you like that? If I'm your investor, if I'm one of you guys, I say, what? You may want to take your money and go, but the fact that other investors are allowed to take their money and go, how is that possible? What happens if this investor says, I want my $500 million and I go? What happens? You are the CFO. What happened? We have to give this guy $500 million. How do we do it?
Well, the value of the fund goes down.
No, it's worse than that. That money is in an escrow account because he's supporting $2 billion worth of snow swaps, right? What do we have to do? You talk to him, the lawyer. What do we have to do to give this guy $500 million?
I guess.
We have to reach out to ski resorts and cities and say, I need to break these contracts. I need the money back. And they're going to charge you a huge penalty for contract breakup, right? Who's going to pay for that? Him. He's so upset. He already is raising his hand. He wants to kill this guy, right? Yes.
But like, why not take a loan? And then
Well, okay, a loan. Okay. Who? Have you ever asked for a loan?
no.
That's why. If it was so easy, you just go to the bank and then you just get loans from the bank. But no, banks don't give loans, not for things like this. No, this is an investment. There's risk here, right? One thing that will become clear to you through these 2 weeks investing is that investing is the act of turning risk into return. And banking is not that business, right? A loan is you lend something, typically with collateral, right? And you collect a fee for that loan. What's the collateral here for the loan?
Everyone else's assets.
I don't have $2 billion worth of assets. I have a nice house, but it's not $2 billion, no. I cannot collateralize that loan, so I can't go to the bank. Yeah, I know the answer. It's going to be no.
So the credit swaps, like the value of the investor that you're cashing out would not work as collateral.
Okay, so so what instrument are you talking about? A credit default swap, or a credit swap?
Or like the investor, they had like a claim on the fund. Could that claim on the fund
Yes.
be like
No. Yeah. What's the fund here?
the snow
Right.
stuff?
I mean, look at the assets and liabilities. Michelle is going to have a very hard time proving to you that the assets are worth anything but the cash, right? What's the value of the snow swaps? As assets, they're worth nothing, right? So you have no collateral. The collateral is the cash. If you don't have cash, you have no collateral. You can't. Doesn't work, right? If this was a fund that had an illiquid investment in an airport, and I own an airport, so sure, I'll take it. I'll use the airport as the collateral. You can't sell the airport, but at least it's something. Here you have nothing, so that's not going to work. We're going to see more examples. We're going to do a lot of trades next week. Not a lot, a few trades. And when we do those trades, it'll become clear where we can use a bank and where we cannot use a bank. You understand this? This is the investment exercise. This is how we do things. And there's many more important things that could go. Investors must read it and be Now, this is the example I mentioned earlier. I forgot who was, but if you want to read, no, he wants to read someone. If you want to redeem, how do you do that? You have to. It's going to be very costly. We went through that. Okay, so let me just go. Some other things. All right, growth. So we're good. We're running. We went through our first year, very successful, right? Everybody made 7.2%. You guys are very happy, and you told all your friends, right? And now I have a fifth investor. You have my fifth investor. So you want to come and, your name is Elon. And you come with $2 billion. I love this, right? So forget about these small investors. You have the big money, $2 billion. And you talk to my director of marketing right there, right? And you say, I want to invest $2 billion in the fund, right? You're very happy. How do you get paid, by the way? We didn't talk about that. I cannot hear you from here, but speak very loud and then.
I think you pay when the fund does well because you take a portion of that.
You want to pay it when the fund does well?
Yeah.
No. No, why would I pay you when the fund does well? I pay this guy when the fund does well. He's the one who picks the investments, right? I pay you for the money you bring me,
Okay.
right? So you're part of my 1%. So let me ask you, how much shall I pay you?
1%, $2 billion.
1%? I mean, 1% is everything I make. Don't ask for everything. Right? How much?
I'm not sure.
Well, if I'm maybe, let's say, I'll help you, okay? You need to learn how to negotiate your salary. That's very important, right? So if you know that the business you bring me gives me 1% of the assets, maybe you start asking me for 10% of the 1%. And I look at that and I say, yeah, that's okay. That's okay, right? I asked my CFO, can we pay her 10 basis points?
Yes.
So, and she's going to cost us how much? $1 million a year.
Yes.
$2 million a year. $2 million. Yeah, I'm fine with that. You fine with that?
Well, I did bring you Elon.
Wait, no. I haven't told you what's going to happen with Elon, okay? We're not talking about Elon yet.
Yes, I have.
So I'm paying you now 10% of the 1%. So you're making roughly $2 million a year. It's good? Okay, by the way, how shall I pay you? We didn't discuss that. You just accept.
Was it performance fees or management fees?
For you, I would say I'll pay you a performance fee. I'll give you a fixed,
And what
a
am I
small fix, $150,000 a year. That's it. No more. Don't ask for more. Don't ask for no, nothing.
No way.
But then I give you, let's say I give you 10% of the performance fee.
That's nice.
Will you go for that?
It's like 3.6 million?
Yeah.
What do I have to pay my analysts?
No, I pay them. This
You
is
pay
just for
them?
you.
Okay.
This is just for you. You don't run your business. I run the business.
Okay.
This is just your salary, right? Okay, you need to hire. You have lots of people to hire analysts here. Look, many of them have not risen their hand yet. Yes. So, okay, but now Elon goes to you, and then he has $2 billion to bring into the fund. What do you say? You say, "Come on,
Need more
that's
salary.
yeah." But then I have a decision to make. Do I want his $2 billion? Yes or no? Do I?
What's the plan for it?
Let me see. Growing a business like this one is like growing any other business. Let's look into that and let's see how we want to grow, right? Of course, the more money we have, the more money we will manage, and very likely the more money my management company will make, right? So I have here an example, right? Let's say that he wants to give $2 billion to the fund, and I talked to my portfolio manager and said, "Can you do another $2 billion worth of?" He said, "No." I talked to every city, every ski resort. There are no more. There are no more. Understand? So what happens? I need to make a decision. What happens if I accept the money? You'll be very happy. But I have to be the one to make the decision, right? And this thing that we're discussing is very common for many of these investment opportunities where there's a limit to what you can do. If you're doing a mutual fund, double everything, no problem, right? But let's look at the financials of my fund. This is with $2 billion, and this is with $4 billion when I only have 100 swaps. So now I invest $4 billion, and now the profits are the same, 200 million, right? I have no more swaps. By the way, you're happy you're making $4 million that year. I know you would be happy, but sorry, stay there, okay? Don't say yes yet. The management fee that we charge is higher, so maybe my CFO is happy, right? 40 million, not 20 now. The net profits of the investors is now a bit smaller because we paid a higher management fee, so it's only $32 million, not 36, right? My fund is doing great. My CFO is quite happy. I said, "Wow, we're making $72 million a year, not 56, right?" My investors are not happy. They're making 3.2%. So maybe you're not so happy now because you get very, very unpleasant phone calls from 4 very unhappy investors, right? But you can say, "I don't care." $4 million, right? But I am the one running the business. I say, "Well, you know what? If you do this, very likely this fund will have to close that year, right? So this is like a retirement strategy for me, right? I would not do it. I prefer to run my business. It's going to give me $56 million per year forever and ever and ever. And in this way, I will blow it. True, I will make $20 million more, $15 million more, but I blow it. Yes? And some funds get blown up that way. Now, that is not very comical. There are other ways of having a fund blow up. One of them is fraud. Performance drag, we just saw one that was self-inflicted. The other one is, my portfolio manager is confused or something, or just a blow up. Sometimes these things happen. Or my investors just don't like this. Say, you know what? It's not so. I'm bored. I want something different. I want to buy Ethereum or something. So, and here's a very good example of death, which is, you may know this guy. His name is Bernie Madoff or Madoff, depends on where in the world you are. And he lost $65 billion to fraud. In fact, I'm not going to go back to the chart that we had, but he had a very interesting strategy. It's called a Ponzi scheme. And so he was the portfolio manager. So he was the head. He was the management company. He was the broker too. So he make his own trades. This guy is one of the creators of the NASDAQ index. He knows how to do trades. He knows how to report trades to the administrator. So he sends all the reports to Michelle. Michelle gets them. They look pretty good. In fact, not only that, the admin company was managing $65 billion. How much are you charging, Michelle?
Charging.
Yes, the fund. How much do we pay you?
I assume fixed income.
Let's say I pay you 10 basis points. Okay? Let's say I'm just making up. It's more than you would normally pay, but let's say what's 10 basis points of $65 billion?
$6.5 billion.
Yeah, exactly. $6.5 billion a year, right? In fact, I'm your only client, right? And I send you my statements, and what happens if you suspect there's something wrong?
I wouldn't accept that.
For 65.
They did nothing. Okay? They did nothing. And this was two employees, you and someone else, you and your buddy, managing $65 billion worth of investments. Right? Yeah, so that's what happened. Bernie Madoff. He died in jail recently. But now let me talk about something perhaps more interesting than all of this, and that's back to the world of reality. And of course, everything we're doing is very ethical, right? We're not doing anything. It turns out we have this snow fund at work. Everything is great, The administrator is working great, 10% return working great. And then I read in the news that a company called IntraWest is going to go bankrupt. Big deal. Companies go bankrupt all the time. But then my portfolio manager, this is what he does, he says, we're in trouble. Because IntraWest is the company that owns all the ski resorts that we had in the portfolio. Now, we know about credit risk, right? This is not good. Not good at all. Because what happens if IntraWest goes bankrupt? Well, we all start praying for global warming. Right? The ski resorts will not pay. So we hope to pay them. The cities will pay. If cities blow up too, then we have a problem, right? Because then you're going to have a very unpleasant phone call to make to our investors, right? You understand this? Right? All right. So I'm not going to get too much into this, but if say we lose $60 million because of Intra was going bankrupt, we still make 20. The investors are going to lose a little bit, 80 million. Of course, they will not be very happy. And now I could ask you again, do you like to be investors or managers? Don't need to answer. Okay? All right. Now, at this point, I am just going to wrap it up very quickly and basically give you a summary of everything, because this is the beginning of everything. I want to use this example and this type of thinking when I describe investments to you. Right? So risk taxonomy are the risks that we can take, and there's market risk. We've spent a good chunk of this course on market. Credit, we spent 2 weeks on that, and we saw both of them show up here, right? And then these others, liquidity risk, gap risk, legal risk, which we also reviewed. You know about the banker's trust case, it's an example of that. And operational risk, which I'm not spending time on, but that's everything else. And the act of investing is turning risk into performance. That's what it is. And for that reason, we need to understand risk. We need to understand what risk is. Now, it's not risk management like we did 2 weeks ago. Risk management is now going to be different. Risk is something we consume and we obtain return. And the question is how much, like we saw earlier. If the return is good enough, I will take that risk. If it's not good enough, I'm not going to take that risk. And that equation that tells us what the performance is for the risk we're taking is what investments are all about. And that is the perspective we're going to take in this week and a half that we have left. Okay? This example that we show is a very good example to understand that. Some ending remarks here is the difference between speculation and arbitrage. What we did here, this no trade, was that a speculation or arbitrage or neither? Well, you could say it was neither, because we were taking risks and we just got paid for those risks very well. The thing with risk is we can mitigate risk by hedging or by diversifying. Hedging, we've learned all about that in this course. Diversifying, no, that's new. That's what we're doing now. These risks we're taking here are diversifiable risks. Not always they are diversifiable, sometimes they are not. But every time you take a risk, you need to get paid for that. If your risks are diversifiable, you diversify, and then that's how you build the good investments. But you can also hedge them. We saw how to do them earlier. And we're going to see next week, we will do a few trading strategies. We will see how hedging works and how it can lead to something which is it looks like almost risk-free. So we are tempted to call it arbitrage, but it's not. There will always be some risks somewhere. Okay. But if you are very, very good at hedging, you can be very, very good at eliminating a lot of the risks that we have. And that's where some people will call some of these strategies arbitrage. It is not the arbitrage we saw several weeks ago, that mathematical arbitrage. It's just that the risk, if you are good, we can minimize that risk a lot and still have a pretty good return on that. We will call that arbitrage, okay? So I'm going to say arbitrage is when we have performance with less than normal risks, whatever that may mean. All right. And I will talk about hedge funds next week, which are my best example of how to minimize the risk that we take and continue to have a pretty good rate of return. I don't want to talk about collateral. I want to end it here. And we're going to take a break now, a 10-minute break. And when we come back, I will get started with the techniques to understand risk and return. 10 minutes. I'm going to continue, and I got some very interesting questions during the break, which I think I'm going to, at the risk of pushing some of the other material towards the end of the lecture, I want to mention this. There's another way to identify the investor column and the manager column, and that is with the word buy side, sell side, as you were saying. The investors are typically called buy side, and the managers are typically called sell side. The best example is, let's look at Canada. Canada is a country which has some of the best buy-side investors in the whole world. Canada Pension Plan, Ontario Teachers Pension Plan, OMERS, OP Trust. I don't know if you know these names, but they are perhaps the best in the whole world at what they do. They don't sell. Canada Pension Plan has the money that's given to them by us. They don't have to go around, like say BlackRock. BlackRock has products that they have to sell, right? And they have salespeople. Canada Pension Plan has no sales, nothing. You know, don't look for a job there doing that. They don't have it. That's what they're called buy side. And Canada has the best. The best. Sell side, the US has the best. These are the hedge funds, these are the BlackRocks, these are the banks, and that's where those services are there. If you're looking for a job in Canada, that's why I always recommend going to the buy side. We have the best, right? And this is like the teachers, the CPP, and the pay is good. It's better than, for example, I know some of the pensions in the United States. Many of the pensions, there's a ceiling to how much you can get paid because you're a public servant. And you cannot be paid more than the governor, for example, in many states. That means that they have to hire people and they pay them $75,000 a year. In Toronto, you can make millions at a pension plan if your performance is good. Just take that into account, okay? And I'll tell you more if you want to know. Okay, I have to continue. So I want to start to deal with all of the stuff that I talked about from a mathematical perspective. Now I want to show you the math that goes into that. I'm going to go very fast. I suspect all of this you know until I get to the very end. Then I will slow down because there's something that I want to do at the end. So I start with the definition of return. You know, the money you had yesterday minus the money you made today divided by the money you had yesterday. That's return. Or you can do the same expression with a logarithm. Nothing new here, right? And you can collect this, and that's the origin of time series. That's how time series are constructed. But you know that. And then you can start to build portfolio statistics, which is once you have a time series, that gives rise to a probability distribution, and its cumulative distribution function in green, right, which you know, cumulative distribution function, or the return density, which is the same thing in yellow. And one is the derivative of the other, and you know that. And this is the beginning. That's how you can start to do statistics. And when you do statistics, one of the first things that we're going to look at is the average return or the mean return, which is what you obtain by taking the returns every day or every month, and then taking the average of that, or the volatility or the standard deviation, which is done in a similar way. But you know, because you're mathematicians, you know that neither of these expressions is the definition of anything. People who are not mathematicians oftentimes tell me that this is the definition of average return. No, it's not. The definition is something probabilistic that lives in the world of ideas. It's what probabilists do. These things that we have here are the estimators for that. The estimators have an advantage, which is that they live on planet Earth, and you can put them into Excel, and with real data, you can calculate them. And they converge to the world of ideas, which is what we don't know. It lives in heaven. If you like Platonic philosophy, this is very well described in Platonic philosophy, right? Because the world of ideas there is reality which we don't see. We only see the world of shadows. He called them shadows, so that would be the statistics, and that's the difference between statistics and probability. And you know that probability and statistics get along very, very well as long as you respect the relationship between them. Okay, there are situations where that relationship is broken, and then what you have is just numbers. I like to say that Microsoft Excel has caused huge losses to investors because investors tend to believe any number that comes out of Excel. Excel does not make mistakes. That doesn't mean that the numbers that Excel tells you mean anything. Understand what I'm saying? And a lot of my job here for the rest of today and next week is to tell you what numbers mean something and which ones are just numbers. And probability and statistics are going to be that. I like to use the concept of heaven and earth. And for those of you, especially if you're Catholic, you will understand the on earth as it is in heaven. You may know what that stands for. That's the recipe that we follow here. We like to do things in Excel that are backed by probability. If they're not, they're just numbers. You may have heard, for example, the semi-standard deviation, one of my favorites. Just numbers. There's no meaning there. Okay? Zero. Now, we are going to have to be very careful with the statistics because I have an example here for you. Imagine I start a fund with $1. I'm very successful. I double my money, but then I lose it the next month, but I double again, and then I lose it, and then I double, and I lose it, and I double, and I continue like that. What are the statistics telling me? Well, from an investment perspective, you know what I'm talking about. This produces nothing, right? But the statistics are pretty good. I have an average rate of return of 25% per month. Right? Losing half of my money is lose 50%. And doubling makes 100%. So the average is 25%. Is anybody surprised by the fact that I make 25% return and I make no money? Are you surprised? Well, you should not be surprised. Because if you look at the standard deviation, you would notice that the standard deviation is very high. And we already saw something here called Ito's lemma. And Ito's lemma tells us that the average return there should be sigma squared divided by 2. So 70% squared divided by 2 is 25%. Right? By the way, marketing people can use this, right? Fantastic. Usually the situation is not as clear cut as this. And investors don't see that you're not really making money, but your average return looks very good, right? If you're mathematicians, you're very quick. You subtract sigma squared divided by 2. I said, no, I don't think those numbers are so good. But it takes some mathematical knowledge to know that. I have spent a lifetime listening to these presentations of investors, so I know. And I know how they try to trick you. And one of the superpowers you have as mathematicians is math. But math, not because it can calculate things for you, but because it's the ultimate nonsense detector. So you should know that your math is very useful to prevent people from misleading you, right? Just be very well aware of that. Yeah, you all like to calculate things and write Python code and this, but the fact that people cannot trick you, that should make you feel very strong, okay? It happens. We'll see examples of that. Okay, so I have examples of how these things, how dirty these things are in practice. This is, for example, something that people spend a lot of time looking at. So look at that, I have here just the average, the rolling average of a certain time series. Doesn't matter what the time series is. You look at the mean of a 2-year window, and then you move that window 2 years. You move that 2-year window ahead day by day by day, and then you get numbers that go up and down. What's the meaning of that? There's no meaning there. Okay, so don't attach any meaning to these numbers. These are just made up numbers. It's Excel giving you stuff, right? More interesting is this graph. It's the same time series, but now I'm calculating the standard deviation. And I don't know if you've read The Little Prince, that book. There's a figure like this one, and the boy starts to argue whether that's a hat or the snake that ate the elephant. What is this in this case? It's neither. This is a numerical artifact. Those of you who've done programming will know that if you have an outlier in a series, the outlier will change the output. And if I do here a calculation, which is a 2-year rolling window, when I have an outlier, and this outlier was caused in 2007, at the beginning of the subprime crisis, that outlier is going to give you some number that will be there for 2 years and then will disappear once the number is no longer in your sample. Many people don't understand that either, okay? But if you've done programming, you've done Python code yourself, you're a mathematician, you should understand that. You know the effect of outliers when you calculate things. Okay, so these things have no meaning. No meaning. That was the beginning of the financial crisis. And if instead of taking a 2-year window, you take a 3-year window, that hat will be broader. It will be a 3-year hat as opposed to a 2-year hat, right? These things, they may sound reasonable, but when you go out there, many people don't understand this, right? So just be aware of that. Now, if I reorganize that information differently, then I suddenly start to do things which have a lot of meaning. What I have here is that disorganized sequence that I had earlier. I've organized it by doing a scattergram on a daily basis. All these numbers that mean nothing, I organize them by putting my mean on the y-axis and my standard deviation on the x-axis, and that's how they cluster. And now this has meaning, because now I can identify the area of high risk, medium risk, and low risk. By the way, this is what you can do with classification trees. This is the beginning of machine learning, right? There you go. But you can tell the difference between machine learning and just random numbers out of Excel. Most people in the financial sector will not know the difference. Again, that's your superpower. Be aware of that, okay? Now, when you take returns and you grow them over time, things get really, really out of whack. And I have, again, an example to explain. What everybody uses to understand returns over time is they use this concept of the time-weighted rate of return. Very simple, and that's what everybody does. You just get returns, say, on a monthly basis or a daily basis, and you compound them like by multiplying them with each other. I have here an example of a fund that I start with $1 and it grows to $2, yes. But this one doesn't go back to 1. This continues to grow. It doubles every month. Look, it doubles. Doubles every month. Wow, look at that. Doubles every month. I've been careful to keep track of the, not just the fund balance, but also the inflows. And I can see that I put $1 on month first and I put no more money. All that money in the fund is money which has been grown internally by the fund, right? And I have a monthly rate of return of 100% every month. The cumulative is just off the charts. Look at that. In fact, they show off the charts that when I get to November, I'm about to win the Manager of the Year award, right? But just before I win that, my friend Elon here reaches out to me and said, how about I give you $1 billion? Well, you know the economics of that. We went through that already, right? Yeah. I'll take it. And then I lose half of it. What happens when I lose half of your money? My cumulative rate of return is still only 102,000%. I still win the Manager of the Year award. Right? But I've lost $500 million. So is that possible? Well, that's because in the cumulative return, I don't take into account how much money I actually made or lost. It's just my relative performance accumulated over time. So for that reason, there's a different measure that people use for that, and it's called the internal rate of return. The time-weighted rate of return is wonderful, but it doesn't really say what's going on. The internal rate of return is a different measure that takes into account the amounts invested over time. And you will recognize there the formula for the bond yield, which is the same formula as the bond yield, where instead of coupon payments, you have is the inflows or outflows into your fund. And the rate of return, the internal rate of return, is the number R defined implicitly by that expression. You look at the final value of your fund, and it should be the discounted value of all the inflows and outflows into your fund. That should measure better whether you've done well or not, right? And of course, when you go back to this example, you would just solve that equation to realize that, yes, the internal rate of return is about minus 50%. Now, you understand the difference because you understand equations. I'm going to exaggerate a little bit. When you go out there in the investment sector, people don't understand the difference. I'm exaggerating, but you will understand, right? And your knowledge of machine learning would be unparalleled out there. Just be aware, these are your superpowers. Don't think that people will have that level of training to understand numbers the way you do. People tend to believe anything out of Excel. Oh, and if you accompany it with a beautiful chart with great colors, it's like everybody will fall for it. That's your recipe for good marketing, right? Yes, understand? Well, use your other superpower, skepticism. Yes? Understand? Good. Continue. I have nothing against math, don't get me wrong, but I have to tell you that math is useful for many things, but it is useless for many other things, especially if you use it in the wrong way, all right? Okay, let me talk about relationships now, because math is very useful to understand relationships. You know the concept of covariance, it's there. And I have a heavenly version and I have an earthly version, both, and they're related. Statistics and probability tell me that both numbers are good. And then I have the correlation. The correlation is the normalized covariance divided by the product of the standard deviations. You know that, and you know that it is between -1 and +1. You know that. You also know that if you put together investments which allocate certain weights given by a vector to assets with a variance-covariance matrix, then the standard deviation of that portfolio is the square, it's the expectation of the square, essentially. And the expectation of the square can be worked out by doing the cross multiplications and doing the expectations and this and that, and then what you get is a portfolio volatility, which is the cross product, the dot product, or the matrix product between your weight vector times this variance-covariance matrix times the vector transpose. In fact, we saw that when we discussed the risk matrix methodology. Remember that? Okay, good. So this is good, and this is the beginning of how diversification is measured. In fact, the fact that our snow fund dropped standard deviation from 50 to 5 when we went from 1 swap to 100 swaps was because of this. If the correlation was not 0, but 10%, 15%, 20%, then you use a version of that. And in fact, we also use this when we're doing credit risk. So this is ubiquitous. This is really everywhere. But this is something which is going to be very important for our considerations, because one of the techniques that started to change everything is the technique proposed by Markowitz in 1952. Picture this, 1952, the first computer had just been invented. Okay? It was called the von Neumann machine, was at the Institute, the Institute for Advanced Studies at Princeton. And so this opened the door to be able to manage time series, because managing time series without a computer is not very practical, right? Right? But this happened, and this person by the name Harry Markowitz in 1952 said, wait a minute, up until now everybody's talking about return, let me talk about risk. And that was perhaps the first person that brought risk on par with return. He did it in a very simple way by only looking at standard deviation. Now we have many more ways of looking at risk, but his two-dimensional thinking changed everything. He got the Nobel Prize in the 70s for that. And his thinking is something very simple. He said, let me do not one-dimensional investing, but two-dimensional investing, okay? Other people did 3, 4, and 5-dimensional investing later. He just said, I'll just do 2. Look at the mean and the standard deviation. Look what happens. I have here the behavior of a portfolio that invests only in stocks at the top right-hand corner. And then when you start adding bonds have a smaller standard deviation. So normally, yes, you would expect the standard deviation of your combined portfolio to go down too. Right? But that only decreases up to a point, because what happens when you get to this nose here, this is the portfolio that corresponds to 70% bonds, 25% stocks. Of course, I'm just making up numbers. But if you go to the 100% bonds, which is 100% in the safe investments, the risk actually goes up. Why? Because you're losing the diversification benefit of the previous expression that we just saw. So Markowitz was aware of that and said, well, if that's the perspective that we want, then if risk can be lowered by combining assets in the portfolio, then he encouraged us to think about investments and as putting dots in a plane. And when I put dots in a plane, I'm going to end up with some dots in a part of the plane, but then there's going to be part of the plane which is empty. This is the too good to be true domain of the plane, right? Those investments, the return is too high for the risk they take, or the risk is too low for the return they give you. That's it, too good to be true. So they possible and impossible investment. And therefore, By math, there has to be a boundary between the two. And then Markowitz says, you invest in the boundary. That's where you invest, in the coast. Okay? You don't invest in the interior, only in the coast. Rational investors will only invest in the coast. And that's pretty good. That's good advice. Now, he doesn't tell you where to invest. I'm just going to leave it there. And I will tell you that if you use standard deviation and return, then this gives rise to a quadratic programming problem that you can solve in a computer. I'm not going to get into whether this is a good algorithm or a bad algorithm. I'm not interested in that. Okay? There are better algorithms today. This became very famous in the 50s, got the Nobel Prize in the 70s. Now there's better methods than this. And this is not a publicity for this as an investment algorithm. It's a publicity for a way of thinking. It's just a publicity for a way of thinking. Because, and this is the interesting part, he doesn't tell you where in the coast, in that efficient frontier, you should invest. He doesn't tell you that. We have to wait until another person came by the name Richard Sharpe, and Richard Sharpe told us where to invest. And I want to show you that too. I'm going to show that to you now. And this is the point where I'm going to pause now. I want to go a bit slowly because I want you to understand this. We already used the Sharpe ratio when we decided that one swap was bad, 100 swaps was good, right? So we already know that it's useful. We already used it today at the beginning of class. But look, I was a professor until 1999. That's when I created my investment company. And then when I created my investment company, I learned a lot of things. And one of the things that I learned is how to understand a lot of the concepts that academics use. It's not, I have the advantage I can call myself an academic or not, depending on the context. I'm both. And I get to speak highly of either or criticize either. I can do that too. This is an area where I learned a lot, and I want you to learn it that way, because when I learned about the Sharpe ratio by reading books, I didn't get it. I didn't understand it. The Sharpe ratio is the division between this expected return and the standard deviation, right? So I had a very simple question that had no answer, which is, especially if you're a physicist, you will understand that it's very unnatural to divide mu by sigma because they have different units. Mu has units 1 over time, where sigma has units 1 over the square root of time. And physicists know that when you do that, there must be a physical reason, and I didn't understand the physical reason. So I only understood that once I got into the investment sector, because then I saw how people get paid. And that's what I want you to understand now. As I told you, the methodology is not what matters, it's the way of thinking. And that's what I want you to understand. Okay? So to understand that, which is the Sharpe ratio, which we saw earlier, I'm going to hire 2 more people today. You're all going to be employed today. I'm going to hire 2 more people. I'm going to have 2 employment contracts with 2 new people. The only condition is you haven't worked for me in the first half of the lecture today. Do I have 2 people right here? 1 and 2. Great. Okay. So I'm going to start with you. So your job is going to be the following. Everybody listens, okay? I'm going to give you some money, $100 million to invest or something. And if you make 5%, I give you $1 million. I'm going to give you a fixed and a variable. The fixed is 150,000, just like you, nothing, okay? But if you make 5%, I give you $1 million. You make 4.9%, you're stuck with your $150,000. You make 20%, $1 million. Many employment contracts are like that. You're given a target. You meet the target, you get it. You don't meet it, you don't get it. Understand? All right, good. Let's get to work. I'll tell you your contract later, okay? You'll be hired after. So you're my first hire. So everybody understands the contract? Everybody understands? So you go to work. And what are you thinking when you go to work?
I want to maximize the probability that I make, like, that I hit my target.
$1 million. You're thinking $1 million, $1 million, $1 million, $1 million. That's all you think, right? Yes? Okay, so what time do you go to work?
9.
9? Oh, we have a problem. We have a problem. What time do markets open?
8:30.
9:30, right?
Depends on the
Equity
time.
markets 9:30, right? That's if it's the American markets. I'm assuming you work in North America, right?
Maybe.
If you had to trade the Hong Kong market, then you have to go to work at a different time, right? Okay. There's a very good way to learn when people go to work, and you just go to where people work, like go to Wall Street, for example. What time do Starbucks open in Wall Street? Starbucks. 6:30. What is that telling you?
People go to work earlier.
6:30. You go to San Francisco? What time do Starbucks open in San Francisco?
12.
Financial sector.
Oh, financial, well, I would say 7:30.
3:30.
Yeah.
Yeah, before it says station.
AM?
Because they trade
Yeah.
infrastructure.
Yeah,
It's time
because
difference.
we're doing it based on.
Same time as New York. They trade the same markets, right? Who would go to work when you show up there and the New Yorkers have taken advantage of all the trades, right? Yeah, they open at 3:30. If you're in New York, you go to work at 3:30. Sure, you're in San Francisco, you go to work at 3:30. So we get that? Yes? Okay, that's how you work, all right? That's the first thing. What time do you go to work? Well, you're in New York, you go to work at 6:30. You're in San Francisco, you go to work at 3:30. Why? Market opens at 9:30. You have to do a lot of work before market opens, right? Otherwise, forget about the $1 million. Like 10 jobs, go and work at Loblaws, something, right? Yeah? Are you following me? Okay, so at least we got it right when to go to work. We got that. Okay, you are there, 6:30. Okay, I don't know if you like Starbucks. Okay, you have your coffee, and then what? 6:30. You read the news, right? And then what? So I want to help you. I'm going to write in mathematical terms what your contract is. Okay? You're going to be paid $1 million if you hit your benchmark. I'm going to call your benchmark R. 5%, 3%, 5%. And this is what you want to do. You want to maximize the probability you make $1 million. Express like that. My portfolio, I call it pi, R is 5. And then you're a good mathematician, you do APM466. You know how these things work, right? You say, well, that portfolio has a mean and a standard deviation, so you normalize. And if the returns are normally distributed, that portfolio disappears because that expression there is given to you by a Gaussian random variable, right? So it is expressed in closed form by the cumulative distribution function of the Gaussian. The first day at work, you can assume things are Gaussian. The second day, no. But the first day, yes. Got it? So you want to maximize that expression there. But maximizing that expression, since that function is monotone, is the same as maximizing a different expression, which is that one. That's the Sharpe ratio. So why is the Sharpe ratio so important? It's because by about 7 in the morning, you realize that you want to maximize this. Right? With the R equals 5. When you read the academic literature, people say that R is the risk-free rate of return. What would you take R to be the risk-free rate of return?
Because if it's almost 100% guaranteed you get that percentage, so you're looking at excess returns.
The answer is, well, so you know the answer. I don't know the answer. I don't know why you would take R to be the risk-free rate of return. Because that would correspond to a contract where you get $1 million if you exceed the risk-free rate of return. I will never pay that. Right? I'm still the CEO of the management company. I'll never pay you for that. You understand? So I don't understand why the Sharpe ratio with R equals the risk-free rate of return makes sense. You understand? I'm exaggerating. This is hyperbole. You understand what I'm saying, right? No, it should be with your benchmark. Let me look at the contract, and then I'll tell you what the R is. Right? And then it makes perfect sense. Of course, people want to maximize the Sharpe ratio, but why? Is it because Sharpe got the Nobel Prize for that? No, it's in your contract. That's how I want you to think when you get a job. Look at your contract. And see how you get paid. Yeah? Yes? So it's clear what you have to do, right? Good. Send me a WhatsApp when you got the $1 million, okay? Now we go to you. Your job is different. You're going to be paid also $1 million, But now you have to beat an index, say the S&P 500. You have to beat an index by 5%. Understand?
Okay.
All right. So what time do you go to work?
6 or 7.
There you go. No, 6:30.
Okay.
6:30. Yeah, we go at 6:30. All right.
Okay.
You go to 6:30, same thing, and you write down what you want to do in math. And this is how it would be written down. I have the same portfolio. Well, sorry, the same letter for the portfolio. The portfolio is different. The benchmark is, I call it Y. Y is the thing is that Y is not a number anymore. So I can do the argument that I did with you, because Y is a random variable. But I can pass the random variable to the other side, and then I can do the same analogy. I can subtract its mean, divide by its standard deviation, and then I want to maximize the Gaussian cumulative distribution function of something else, which is written there in brackets, right? Of course, I'm assuming that the portfolio is normally distributed. If it's not normally distributed, well, you have to work a little bit harder. But there's no problem, you're mathematicians. So you want to maximize that. This function is monotone, therefore you want to maximize this ratio. Looks like the Sharpe ratio, but it's not. What's the difference? What's the main difference? The main difference is that what's in the denominator is not the standard deviation of the portfolio. It's the standard deviation of the difference between your portfolio and the benchmark. It's called the tracking error. So the first thing we observe is the difference between your job and yours is that in your case, minimizing risk pays is good. In your case, no. You need to minimize the deviation from your index. We got that? We know that, and that's about 7 in the morning, right? So maybe, since you know your deviation from the index has to be small, the first thing you do before markets open is you go and you put all the $100 million in S&P 500 futures. Why? That guarantees that if the S&P goes up, you go up. And the S&P goes down, you go down. You want to go down when the S&P is going down, right? Right? So you're making the tracking error small. That's already a win. I mean, this is very risky what we're doing, but you understand what I'm saying, right? I'm not giving you a trading strategy. I'm telling you a way to think. That's all I'm doing. And the advantage is that now that you've taken care of your tracking error by putting all $100 million into the S&P 500, you still have the $100 million left because that doesn't require money. Well, 5% margin, right? Now you just need to figure out a way to make 5% on the $100 million, right? Right? So what do? Well, you give it to him. Right? You give it to him. What's your name?
Daniel.
Daniel. So Daniel, how about you manage not 100 million, but 200 million, yours and mine. And you make 5%, I give you $500,000. Why not? You can say, no, wait a minute. No, I want to compete with Daniel. I want to make. But then I have a different proposition for you. Everybody understands what I'm saying? Right? You understand that your objective function is different, and you understand that the optimal solution to that portfolio, whatever it is, you write your Python code. I'm not talking about that. Again, it's a way to think. Put it all into S&P futures, and the $100 million, give it to Daniel to manage. He's good. Right? Because now you don't have anything to do. He's doing everything for you. And then what I would suggest is talk to her, the marketing person, and say, let's go there and let's just raise more money. $100 million is not enough. I don't have anything to do. And then you become a selling organization, and you're a management organization. Understand? You understand what I'm saying? Now you're sell side. Now you're buy side. Are you following me? You're a hedge fund. That's what you do. You just trade all day long and make a lot of money for others. Right? You get paid. And what do? You don't have anything to do, but you know that if instead of $100 million, you have $1 billion, Elon is right there. Talk to him. Get $1 billion from this guy. Right? Give it to him, and then you're rich. You're rich by doing nothing. No, sorry. You are rich by doing something very, very important. Selling. With her. She's right there. She's waiting for you to hire her. You understand what I'm saying? Do you understand how the business works now? In the investment management sector, there's people who make money and people who sell money. So the first two blocks I gave you at the beginning of the class, they're actually here. It is the result of this optimization algorithm. That explains everything. That explains everything. And this has a term, it's called portable alpha. People like to use the term alpha and beta for these investments. Alpha is after return strategies, prop tests, hedge funds, things that you have heard. And they have to make money with what's called a cash benchmark, 5%, 10%. And then you have the beta people, which are the private equity firms, the mutual funds, and these are the very big funds, very big, because all they do is sell. And then someone else will be making the alpha for that. They're called alpha and beta because of the connection between this and linear regression. And you know linear regression, I don't have to tell you that. I will just tell you that investments are a function of risk factors. What we'll spend time next week is figuring out how to get money from the risks that we consume. Risk is something you consume, and risk and return is something that's given to you. Okay? And that relationship between risk and return, at first level, is going to be done by linear regression. Now, you guys know about regression trees. You know that this is just, again, a way of thinking. When it comes to algorithms, you can do better. So allow me to talk about linear regression, knowing that you know how to take this to higher mathematical levels. Yes? Okay, so I will just tell you, when you have two investments like that, okay, you know that this one, they share somehow the same risks. They seem to go up and down at the same time, but the blue investment always seems to be a little bit ahead. So it's ahead with the alpha, and the beta is the risk that they share. And this is obtained by the regression line, which you all know. And you know about R-squares and p-values and all of that, right? All of that is just a way to understand the sources of risk. And I could talk about principal components, and I could talk about music, and eigenvalues and eigenvectors, but we've done that already. So I don't need to. I want you to understand all of that in the context of investments. If you have an investment, why? With risk factors, which are market factors, which you can obtain for free through, say, for example, future transactions, then there's a way to break up your return into those specific investment factors. You know that in the case of uncorrelated factors, the betas are related to the covariances. If not, you have to solve a certain equation with the covariance matrix. Big deal. The regression line is there, and you know what it measures. All of this you know. And in fact, many of you would know how to go beyond linear regression to other things, including neural networks and vector machines and all of that. I don't want to tell you that. Just make your own connection into that. Because that becomes an algorithm, and I'm not interested in algorithms for the third time. I'm interested in the way of thinking. And you can do this in higher dimensions, and you can go nuts. All right? That's it.